Hello and welcome to BQ Prime. I'm joined by Saugata Gupta, the MD and CEO of Marico Limited, to decode the second quarter earnings. Thank you, Mr. Gupta, for joining us. Let me quickly do a
Yeah,
quick
thanks for having
recap
me.
of the quarterly figures. Net profit rose 17.3%, which was in line with estimates. Revenue dipped marginally by about 1%, owing to the pricing action. Now, operating profit rose 15%, again with line with estimates. Operating margin, in fact, expanded to 20.1%, beating estimates, while gross margin was at its 26 quarter high, owing to the softer input costs. Volume, what we have seen, grew 3%. Now, there was no change in the volume growth when compared sequentially. Mr. Gupta, we know that the demand trends in the domestic FMCG sector in the second quarter stayed largely in line with the preceding quarter. However, I would like to know from you, what is the demand environment looking like as we speak, especially the rural demand?
Let me just give you a flavor of the overall demand situation. I think if you look at Q2, I think we started off well in July. And then there was a kind of a rainfall deficiency that happened that weakened sentiments in August. Things have started improving. Now, if you look at the Nielsen numbers, I think the volume growth, while most of the companies which have reported volume growth currently has been in low single digits, the Nielsen number is slightly higher. I think two things which are encouraging. I think, and it's also for us, is the offtake growths have started picking up, and we believe that normally, growths, secondary growths lag offtake growths, and therefore some of the growth is expected to pick up. All in all, we have had a decent monsoon, and we expect obviously the rural things to gradually recover. The second thing that has contributed to the lower volume growth in the sector, and I'm talking specifically for us, but it is also there in some other sector, some other mass segments, is that we have seen a higher participation and proliferation of some of the smaller brands, which are regional brands. Some of, in our case, some of conversion has happened back into people have lapsed into unbranded. That has happened because of when there is high inflation, people tend to downgrade or titrate consumption. And thirdly, because I think that's unique to us, and I said it could happen to others also. You see, whenever there is tepid revenue growth in especially in the GT urban system, where a combination of the fact that there's been revenue growth, negative revenue growth because of deflation. Also, I think in urban, the impact of e-com and modern trade is higher, and therefore the general trade contributions have reduced a bit. Whenever there is negative revenue growth with high costs, they tend to impact the distributor and ROIs. That leads to lower credit in the market. That has reduced STRs, at least in some of our core brands, by 4-5 days, and that is another reason why the volume growth is low. Now, that STR correction is one time; it doesn't happen long time. We believe as some of the commodities start inching up in the next quarter, the participation of we will be more price competitive in the second half of the year, and we have already taken some of the pricing action. So volumes will improve. As far as revenue is concerned, the anniversarization of most of the price cuts are behind us, and therefore that lag will also correct itself, and therefore revenue will be broadly in line with volume growth as we enter the second half.
All right. So just to follow up to this question, talking about the local competition. So do you wish to take further price cuts in order to protect your market share?
So far, whatever price cuts we have taken is, I think, fairly okay, because I said that we are now going to enter an era where things will inch up a bit, all the commodities. So therefore, I think that will put us at a pricing advantage. Secondly, I think the other thing which we have done is that while we have continued to deliver very good margins, we have not cut A&P spends at all. If you look at our Q2, our A&P spends are fairly robust. And that A&P spends, to me, investment to grow, investing behind distribution, investing behind brands. Pricing might not be just the only lever of growth.
Right. So I should say that Marico's margin-driven earnings delivery in a muted demand setting is really encouraging. Could you also tell us your margin guidance for FY24?
we have indicated that we will obviously try to expand up to 200 basis points. We should be able to deliver a margin which will be one of the highest in our history. Having said that, I think over the medium term, our endeavor is to maximize volume growth and market share subject to a threshold level of margins. This margin improvement has happened just not because of raw material, but also because of a significant improvement in our food gross margin structure. Because food has been one of the drivers of growth, and a lower gross margin would have had an impact on our overall margin. The second thing, we have considerably reduced cash burn in our digital business. I think compared to a lot of standalone businesses, our digital businesses cash burn is far, far lower. And I believe now we have a model. As we scale up, we will exit 400 crore plus in our run rate, and at least one, and if not next year, another one or two of our digital brands will turn profitable. And over the next 3 to 4 years, there is a very likelihood that there will be healthy EBITDA margins from our digital business, because I believe that we have developed the capability to profitably scale up digital businesses.
All right. Digital business, we have all the details from you. But if I have to look at the food and the personal care, especially the premium personal care portfolio, we have seen that you are aggressively scaling up those two segments. If I'm not wrong, those two segments comprise 20% of your domestic revenue. So you are also eyeing profitability and 1,000 crore revenue for the food business. So what are the key categories within the food segment are you focusing on?
As far as food is concerned, I think we have enough on our plate. We have, I think the oats business is extremely successful and profitable. I believe that we have to ensure that the next two categories where we'll scale up and expected to cross 100 crore plus is honey and soya. Plant protein is something which we believe has tremendous opportunities for growth as people look at healthy substitutes in eating. We are also in spreads and snacking. We are prototyping snacking and ragi, and therefore one of the things across our food portfolio we are very much focused on is how do you drive the usage of millets. It's an extremely healthy alternative. It's a grain which is grown in India, and it's something which we want to support actively. And therefore, I think whatever we have, I don't see ourselves entering any new categories. But in food, what is important is to get scale so that profitability comes with scale, and therefore focus on whatever we have and scale up in a profitable way.
All right. And lastly, your personal care. I know premiumization is a strategy that you're actively focusing on. So your plans to further scale up, and also is there a revenue target to share for this particular segment?
No revenue target to share, but obviously this entire diversified business, which is premium personal care plus digital plus food, which contribute to now nearly 20% of our turnover. This is something which we need to continue to grow, because obviously if we have to have high volume growth aspirations over the medium term, this part of the business has to grow aggressively. I think what we have done, there's still a work in progress. One, profitability is something which we need to look at. The second one is distribution. If this segment is going to grow in a kind of a sustained way, I think we have to expand further in our chemist, cosmetic and food channels, where we are slightly under indexed, because our existing portfolio is far more grocery. And so that is one area which we still need to do some work on, because that will only drive that sustainable profitable growth.
All right. And I cannot, not ask you this. So when do you expect the revenue growth to move into the positive territory? Is the second fiscal right to assume?
I think in the second half, we should get into positive territory. As I said, that the deflation component will get neutralized, and therefore the revenue growth will mirror the volume growth. So it will be in positive territory in the second half.
All right, sir. Thank you so much for your time. It was a pleasure talking to you.
Thank you. Bye-bye.